Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
All right, let's jump right in. If you've ever had to deal with really complex R&D funding arrangements, or maybe you've been paid in stock by your customers, well, your accounting work is about to get a whole lot simpler. Today, we're breaking down FASB's latest big update, ASU 2025-07. And that's really the core idea here, isn't it? For years, accountants and finance pros have been wrestling with these rules that just felt way too complex for some pretty common business deals. FASB heard those complaints loud and clear, and this new update, well, it's their answer. It's designed to cut right through the red tape. So, the official name is ASU 2025-07. You can think of it as a really targeted update. It's not trying to change everything, but it's zeroing in on simplifying the rules for two specific headaches: contracts whose value is tied to a company's own internal operations and, you guessed it, payments from customers in the form of stock. So here's our game plan. First, we'll look at the two big headaches this update is meant to solve. Then, we're going to dive into the details on the new exception for derivatives and the new clarity around share-based payments. After that, we'll get into the practical stuff, the key dates and how you can transition, and we'll wrap it all up with the bottom line. Okay, so why was this update even necessary? I mean, what was the big deal? Well, this wasn't just some academic exercise. FASB put this out in direct response to feedback from companies, from auditors, from people in the trenches who were saying the existing rules were creating a ton of unnecessary cost and complexity in two very specific areas. And this really lays out the two core problems perfectly. On one side, you had these super complex derivative rules getting slapped onto contracts that were based on a company's internal milestones, things that often didn't reflect the deal's true economics at all. And on the other side, you had total inconsistency in how different companies were accounting for share-based payments from customers. ASU 2025-07 is designed to tackle both of these head-on. And here's the end game, what FASB is really trying to achieve. Their goals are crystal clear. Make accounting less costly and less of a headache. Make sure the financial statements actually show what's going on with these deals, and, just bring more consistency across the board so everyone's playing by the same rules. All right, let's get into the first big change. This is all about creating a new scope exception for derivatives. Basically, it's carving out a simpler, more common-sense accounting path for a very specific set of contracts. So, what kind of contract gets to take this simpler path? Well, there are two key things to look for. First, the contract can't be something that's traded on an exchange. And second, this is the really important part. The underlying, which is just the thing that determines the contract's value, it has to be based on the unique operations of one of the companies involved. Think things like hitting a product development milestone or getting a green light from regulators. Now, to make sure everyone's on the same page, FASB was also very clear about what doesn't qualify. So if a contract's value is tied to a broad market index, say the S&P 500, or the price of a financial asset, or even a company's own stock price, nope, not eligible. Those contracts still have to follow the existing, more complex derivative accounting rules. Let's make this real with an example, because that always helps. Imagine Company B gives Company A $50 million to develop a new drug. In return, Company A agrees to pay B back based on two things happening. One, getting the drug approved, and two, hitting a specific profit target. This contract, it gets the new, simpler treatment. And why? Because both of those triggers, the regulatory approval and the gross profit, are tied directly to Company A's own specific operations, not some random market index. Okay, that was part one. Now for the second major piece of this update. Let's pivot and talk about how ASU 2025-07 brings some much-needed consistency to how we account for share-based payments we get from customers. The most important thing to remember is right here. This update makes it absolutely crystal clear. When you get shares or options from a customer as part of a deal, you always start with the main revenue recognition standard, which is Topic 606. No more guessing games about whether some other complicated guidance might apply first. And this brings us to a really key concept, the unconditional right. This is the trigger point. You can only start applying other, more complex accounting rules, like the ones for derivatives, after your right to that payment becomes unconditional. So what does that mean? It basically means you've done your part of the deal, and the only thing left that has to happen before you get paid is for time to pass. This slide highlights a super critical distinction. Under Topic 606, you have to ask why the value of that payment is changing. If it's just because the customer's stock price is bouncing around, a change in what the guidance calls form, you don't go back and adjust the revenue you've recognized. But if the number of shares you could earn changes because of your own performance, then you absolutely do have to adjust the transaction price. Let's walk through another quick example to see how this plays out. Say a company has a deal where they'll get a bonus of 100 stock warrants from a customer, but there's a catch. They only get it if they successfully deliver 1,000 units of their product. So how does the accounting work? Well, following Topic 606, the company estimates the value of those warrants and starts recognizing it bit by bit as revenue as each unit gets delivered. But here's the key. Those complicated derivative accounting rules for the warrants, they don't even come into play until the exact moment that 1,000th unit is delivered. That's the point their right to the warrants becomes unconditional. All right, we have covered the what and the why. Now for the really crucial part. How and when do you actually put these changes into practice? The timeline here is pretty straightforward, and there's good news. You can actually early adopt the standard right now, as long as your financial statements for that period haven't been issued yet. If you decide to wait, the official date it goes into effect is for fiscal years that start after December 15th, 2026. And you also get choices for how you want to make the switch. You can go prospective, which just means you apply the new rules to new contracts from your adoption date onward, simple as that. Or you can choose modified retrospective, which means you go back and adjust the accounting for your existing contracts by making a one-time tweak to your opening retained earnings. And this is a really cool detail, so listen up. FASB is giving companies some serious flexibility here. You can actually pick one transition method for the derivative part of the update and a totally different one for the share-based payment part. You don't have to use the same approach for both, which is a nice touch. So let's pull this all together. What's the bottom line? At the end of the day, what does this all really mean for financial reporting? It really just boils down to this simple idea. One single targeted update from FASB is solving two distinct, long-standing accounting headaches. It's all about a focused effort to simplify and to clarify. So, if you only remember three things from all this, make it these. First, there's a new, simpler accounting path for those contracts tied to your company's own internal operations. Second, when a customer pays you in stock, your accounting always starts with the revenue standard, Topic 606. And third, the whole point of this update is to lower costs/complexity and drive more consistency. And that leaves us with one final thought to chew on. This update is a clear step towards simplification. But as business deals get even more creative and complex, the big question is, how will accounting standards keep adapting to keep pace without just adding back all the complexity they're working so hard to get rid of? Something to think about.